The numbers are on the rise, but overall, I believe they are still relatively muted for now, historically.
Well, if you compare them to the pandemic or to the global financial crisis, defaults are lower. And that's true. I think the risk is that even if rates come down, they'll stay elevated. And so for highly leveraged businesses, the sort of the purview of the LBO and private equity-backed sponsors businesses, the risk will remain prevalent. Even if we think it'll peak this quarter, we think that there's continuing risk.
So how do default rates and default dollar amounts then compare to, say, normal, non-pandemic, non-crisis times?
Well, historically, the other thing is, after those last two crises, rates went down to almost zero. So defaults peaked very high and then dropped precipitously. We don't expect that to happen this time. The Fed may take rates down. We don't think they're going to take them down nearly as low as they did after the last two cycles. So there's going to continue to be pressure on the most highly leveraged businesses.
And it's not just directly higher borrowing costs, I would assume, meaning that companies have to pay more for their debt. It's probably the impact that those borrowing costs are going to have on the overall economy.
Well, two things happen. The higher rates slowed down the economy, so that earnings lift that you thought you were going to get when you bought that business in 21, levered it up, paid a high multiple, that earnings expectation has declined. The other thing that happens when you take rates up is asset prices, decline as well. So valuations are lower. So there's pressure on those businesses that'll persist.
Well, private equity is going to private equity. That's what they're going to do. They don't sit on money to not invest it. So
correct.
Sounds like private equity might have made a lot of bad bets or bad forecasts about where rates in the economy were going in 21 and probably overpaid for companies that they should not have overpaid for.
True enough. And as I noticed you mentioned direct lenders, one thing that did happen in 22 and 23 when rates came up and the market got a lot more sort of risk averse, they came in and refinanced some of those deals. So there was some additional liquidity that came into the market through the private credit side.
What does that mean?
It means that if you're worried about liquidity for the weakest companies, the fact that private credit has been able to grow more capital and provide some lending to the private equity sponsored businesses, it alleviated some of the defaults. It doesn't solve the problem, but it definitely created a valve when the syndicated loan market, for example, wasn't there.
Got a beautiful chart on the wall, this giant wall behind you, and it's breaking it down by sector. There's a lot going on there. Kind of looks like my EKG when I used to anchor the 5 a.m. show. Media, our industry, we know it's been just suffering. Companies are going bust left and right, laying people off. What do you see from a sector perspective? Which ones are most at risk now?
I always like to start with the point that the most at-risk sectors in this environment are LBOs. So you take all those companies, the majority of them might be a consumer goods company, might be a retail and apparel company, but it's probably owned by a private equity sponsor. That being said, you think about something like the durable sector. They did really well during the pandemic. We were all stuck at home buying stuff for the house. That changed. Now people...
That's home goods and stuff, a durable.
Yeah. So now you're done buying home goods, and what you really want to do is take a trip. So those businesses are actually doing better. The stay-at-home businesses are doing worse. But then overall, that high-rate environment just changes the consumer behavior to some degree. Consumers been pretty strong. Americans are good consumers.
Telecom's pretty high, at least the projection heading out to January 25. According to that chart, it's tapping 20%.
Those are more vulnerable businesses to start. So they, those are businesses that are having more of a secular issue. So if you dive into each of these companies, there are some idiosyncratic characteristics, but the big problem is they can't afford the debt on their balance sheet.